What are the top 10 rental property tax deductions you can take this tax season? You want to know the answer? Stick around till the end of today's conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you're to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation with you about a very important topic. What are the top 10 rental property tax deductions that you need to take, that you have to take, that you can take this tax season? Before we get into the nitty-gritty, let me first say that being a landlord can significantly bolster your savings, right? But it's also a lot of work if you really think about it. So on top of the finances and responsibilities of your own living space, you have to find tenants, you have to secure insurance, you have to pay a mortgage and property taxes, the whole 9 yards. So renting a home can also complicate your personal tax situation. The great news is that the IRS and Congress have put in place a few deductions, a few tax breaks for those of us who are in the rental property business. So first, you can deduct loan interest. So most homeowners use a mortgage to purchase their own home, and the same goes for rental properties. So landlord with the mortgage will find that loan interest is their largest deductible expense. To clarify though, you cannot deduct the portion of your mortgage payment that goes toward the principal loan amount. Instead, the deduction only applies to payments toward interest charges. So these components will be listed separately on your monthly statements and are therefore easy to reference. So you simply want to multiply the monthly amount by 12 to get your annual interest, your annual total interest. Number 2, repairs. So besides loan interest, you can also deduct repairs. And the cost of things such as fixing a busted garbage disposals, swapping out light bulbs, or patching holes in the wall, it's usually tax deductible in the year you incur the purchase. So here are a few examples of things that the IRS says usually have to be capitalized. Now, what is capitalization? Capitalization means that you cannot deduct the whole expense when it happens. You have to deduct that expense over several years. And when it comes to, when we talk about deducting capital expenses, we talk about depreciation. So what are the things that the IRS says you have to capitalize? You have additions, landscaping and sprinkler systems, storm windows, new roofs, security systems, heating and AC systems, water heaters, flooring, and insulation. So anything else you can expense. Anything else you can actually just deduct it on your tax return, no problem. Number 3, we have property tax. So property tax is an expense you can easily deduct, and almost every state and local government collects property taxes. So depending on your rental property's location, they can range anywhere from a few $100s to hundreds of thousands. And you can find the exact tax rate in your area by checking your escrow summary or inquiry with your tax professional. And if your state has rental licensing requirements, you can also deduct any accompanying landlord or vacation rental license fees. One thing that I want to say here is, and this is very critical here, folks. So if you manage short-term rentals, your state, city, county, or town could charge a fee known as occupancy taxes. And this is kind of this is akin to sales tax, but you can deduct occupancy taxes too. And that's number 3. Number 4, insurance premiums. Those are also deductible come tax season. So lenders can stipulate that homeowners get an insurance policy before securing their mortgage. So luckily, any form of insurance is considered an ordinary and necessary rental property expense and thus is deductible. The great thing here is that the deduction I'm talking about here applies to basic homeowners insurance as well as peril and liability insurance. That's kind of cool. And if you have employees, you can deduct the cost of their health and workers' compensation insurance too. Although insurance premiums tend to be a bit higher for rentals, this boost can help offset that. And the landlords also can deduct losses, including those caused by hurricane, earthquake, flood, and theft. Next, we have depreciation. I was actually talking about that earlier when talking about capital assets, and this is number 5. So over time, what happens is that wear, tear, and obsolescence lowers the value of your rental property and its content. So this process, known as depreciation, is tax deductible, and you can actually claim depreciation as soon as your home or apartment is available for rent, even if you don't have any tenant yet. So the deduction can be taken for the expected life of the property, but it must be spread over multiple years. It is critical to note that the value of the structure can depreciate, but not the value of land, right? Land never depreciates. Number 6, utilities. So every landlord handles utilities directly. So if you choose to cover things like gas, electric, water, heating, and AC for your tenants, they'll be tax deductible. So if the tenant takes care of those expenses himself or herself, then you can't write it off, right? So if you pay the internet, cable, or satellites, you can deduct those as a utility expense as well. So even if your tenant agrees to reimburse you for utilities later, you can continue to file the rental property deduction and claim the reimbursement as income. Number 7, legal and professional fees. So if you are a landlord, you can deduct certain professional fees in relation to the rental property. So let's say if you use a certified public accountant or computer software to prepare your tax return, be sure to deduct the cost. This is important. And you can hire a lawyer to oversee rental paperwork at any point in the year and still deduct those exorbitant hourly fees. And if you use a real estate agent to fund your tenants, you can write off the commission. If you advertise the property in the newspaper, over the radio, or online, you can deduct the ad dollars. So even advisory services can be written off so long as you meet to discuss the rental property. And if you have to evict someone, this deduction would help cover the legal and court filing fees. So what I'm trying to say here is that these are all considered by the IRS as operational expenses and should be written off. You cannot, however, and this is very important, you cannot, however, deduct legal fees used to defend the title of your property or recover and improve property. Number 8, travel and transportation. So if you are a landlord that travels to multiple properties, or your rental is located far from your residence, your transportation expenses are deductible. And here I'm talking about everything from paying to show your rental property, collecting rental income, or conserving your rental property throughout the year. Excluded from this policy are any reasonable commutes made regularly though. And you can deduct travel using 2 methods. So the IRS has approved 2 methods. So you have actual expense method, and you have the standard mileage rate. So for 2021, the standard mileage rate for business use is 57.5 cents per mile. 57.5 cents per mile. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm very happy to still having a conversation with you today about the top 10 rental property tax deductions. And for tax season is right upon us, and we need to know exactly what you can write off as a landlord. Number 10, office space. So whether you conduct business in a commercial property or your spare bedroom, you can deduct the accompanying cost. Square footage or rental costs will probably be the largest expenses, but you have to include the price of a printer, for example. If you have one, you can include ink, a phone line, computer software, and anything else you use to get the job done. One thing you want to make sure is that you want to keep the paperwork. You want to keep documentation of the purchases you make and records for the time you spent managing your property. because this is one of the most commonly flagged deductions. Be sure you're keeping yourself honest about the breakdown between business and personal use in case you get audited. Number 10, last but not the least, other expenses. So those things might also be deductible. You have transportation expenses associated with collecting rent, managing your rental or maintaining it, advertising your rental, insurance on your rental, utilities, and in general, also I want to mention the fact that there are certain things you cannot deduct. You cannot deduct. So travel between your home and the rental property. The IRS considers that commuting unless your home is a principal place of business. Uncollected rent, but this depends on the accounting method you're using for your rental income, whether you're using the accrual method or the cash method, depending on that. And we have an entire show on the accounting methods that small business owners, including rental property, including landlords, use. So this will really depend. And so in general, you cannot deduct travel between your home and the rental property, uncollected rent, and you cannot also deduct lost income because your rental was vacant. So we are currently in an economy where in some sectors of the country we have high vacancy rates, and simply because your property is vacant doesn't mean that those losses should be attributed to the IRS or should be attributed to all taxpayers. So the IRS does not allow landlords to mutualize their losses, to mutualize their vacancy losses. So if your property is vacant, you cannot actually write it off. You cannot write off the lost income. All right, folks. So you've got it. So the top 10 rental property tax deductions, I've given them to you. Let me first talk to you about how to claim rental property tax deductions. So the thing here is that in general, you should file rental property tax deductions the same year you pay the expenses using Schedule E. And the process will be much more manageable if you keep detailed records of all income and cost related to the property as they occur. Because the last thing you want is that if you are ever audited, you want to be able to provide all the paperwork, you want to be able to substantiate, to provide proof for every deduction you claim, right? And I have talked to you about several rental property tax deductions, but the filing process gets more complicated if you use the rental property as your primary residence at any point in any given tax year. So each year's Schedule E form denotes the number of days that you can personally use your home and the percentage of days that the property can be rented out at fair market value before anything changes. So this is kind of very important in terms of how you need to separate your personal life versus your business life. In most cases, I just want to mention that very quickly, is that you will not be able to deduct expenses or losses for personal use under Schedule E. And one thing, in those cases, you can still file them using Schedule A form. And if you choose to itemize your deduction rather than take the standard deduction option. And one thing I want to say before closing today is that you can actually have a way to monitor everything if you are able to either hire someone to track your finances for you, your financial items for you, your expenses for you throughout the year, or you can get an app. There are apps right now that allow landlords and rental property investors to actually track their expenses there, so that come tax season, they're able to write off things. They're able to identify and take the best tax write-offs, tax breaks as soon as possible. So you can use software, you can use an app, a mobile app, or you can just hire someone. All right, this was it for today, folks. I really appreciate your attention today. I really thank you. Here is a recap of today's conversation. The top 10 rental property tax deductions. You have loan interest number 1, repairs number 2, property tax number 3, insurance premiums number 4, depreciation number 5, utilities number 6, legal and professional fees number 7, travel and transportation number 8, office space number 9, and other expenses number 10. Thank you so much for your attention. I really appreciate it. Until next time, please remember, stay marvelous.